Welcome everybody to our seminar series, IBS seminar series for this academic year. It's very exciting to start it with one of our own, Andrew Phillips, who I'll let Karu Balding introduce Andy, but before that, I just wanted to also remind you, of course, that we will meet here every Monday, for now, remotely, unfortunately, but hopefully at some point during the semester or the year, at least, we'll be able to start doing hybrid formats in order to accommodate folks that cannot be here, just to take advantage of that very great thing about the format, while also hoping creating more community and being in person at some point in the semester or the year. But we'll monitor the COVID situation and so on, of course, and decide based on that. Without further ado, Karu, thank you.
Hi, everyone. It's great to see you. And welcome back to the speaker series. I'm really happy to be able to kick off the speaker series by welcoming Andy Phillips. Andy is a scholar of comparative politics and political methodology, and he joined our department in political science at CU in 2017 after finishing his PhD at Texas A&M. In that short time, he's published 20 articles. I was looking at your CV this morning, Andy, and it's daunting and impressive, including a lot of work on political methods, and then also really interesting substantive work on a range of topics, including gender and budgeting processes, and the effects of Donald Trump's tweets on financial market volatility. I encourage you to take a look at that paper. He also has 2 books that are under contract that he's working on currently. So just really contributing a lot of super interesting research. I also want to just add that he is a teaching superstar. He is helping our whole department with methods kind of all the time. And we're really grateful for that. And I'm very pleased that he's interested in joining IBS as a faculty fellow with the program on international development. So without too much more talking, I'll hand it over to Andy to present his research on Mind the Gap, Policy, Dissonance, and Financial Markets, which is co-authored with Alison Benton from the City University of London. So Andy, thanks so much for joining us, and I really look forward to hearing your talk.
Great. Thanks, Karu. Thanks, everyone, for stopping by. So if Karu talked about the Donald Trump paper, so this one is not too far off, which may be good or bad for you. So this paper is entitled Mind the Gap, Policy, Dissonance, and Financial Markets. This is co-authored work with Alison Benton, who is whatever the British version of a professor is, at City University of London. So I first met Alison in Brazil, where she took a class that I was a TA for, and she asked way too many time series questions, and now we co-author on papers together, which is great. So really, Alison's work is highly kind of integrated in with financial markets, which I do a little bit of, and then also my interest in methods, and we've kind of been able to join this together for a series of projects. And in this one, the general idea is really how do unexpected events affect financial markets, which there's a pretty big literature on. But we kind of come at it through a different lens by looking and seeing whether elite speech, in particular speech by policy elites that's either dissonant or inconsistent with their previous statements, how does that unsettle markets? And really, it's how do they respond to these unexpected events, and how does that affect markets as well? So as I mentioned briefly, there is a literature on how events affect financial markets. One big cause are human-related events. So evidence that military attacks, such as the duration of conflict, when conflict occurs, and how intense the conflict is, tends to affect financial markets. Terrorist attacks as well have been shown to affect financial markets. That, of course, is a little bit more exogenous and uncertain, but evidence kind of shows that when terrorist attacks happen or military attacks, that asset prices tend to fluctuate, and then volatility increases in markets as well. So just as an example of this, Schneider and Troger have a paper where they look at fighting during the Gulf War, the Yugoslav conflict, and the Israel-Palestine conflict. And they find not only that basically like conflict in those regions has these spillover effects and goes on to affect market volatility in places like the US, France, and the UK. So that's for human causes. There's also literature on kind of slightly more exogenous events and things like natural disasters. So these would be like floods, earthquakes, tornadoes, tsunamis, as you see here. They also can affect financial markets. So natural disasters, extreme weather events, these are things that can be not really anticipated to some extent. And so they affect markets as well. There's a little bit of work, and this is kind of related to what I'll be talking about today, on how pandemics, so I believe some of this research has looked at the Ebola outbreak as well as COVID-19. These are all really new papers, and they kind of show that certain responses to pandemics, such as lockdowns, also seem to affect financial markets. But this is like a super small literature. So as examples of this, Hood et al. Find that earthquakes and tsunamis in Japan tend to hurt equity markets. Interestingly, there's another paper that shows that events that happen in one country can have these spillover effects to other regions. So the Southeast Asian tsunami actually affected all currency markets in emerging markets, not just the countries that were directly affected by the tsunami. So our question, to kind of ask here is like, what's the process by which these events actually affect markets? So we have some sort of what we've termed major violent events on the two slides you saw previously. That leads to direct human and physical capital losses. So people die, things get destroyed. This, of course, affects businesses and their ability to operate, and things like costs and supply chains, which in turn goes on to affect individual and firm level of consumption and investment. This goes on to raise general macroeconomic uncertainty, which for investors changes their views about current and future prices of their assets. And so they'll tend to shift their portfolios in response to these events. And so what we'll see, and we'll talk much more about like how this is measured, is it'll go on to rattle financial markets. So what's missing from this literature? Our kind of question here is, can government policy interventions meant to manage these violent events also affect markets? And so I mentioned briefly, there is a small literature on government policy and how that may affect financial markets. So lots of interesting papers on COVID. But even this literature treats policy as a set given thing. So a government, adheres to a lockdown, and once that's in place, it's going to remain constant over time. We, of course, know that even the most carefully designed policies often are really inconsistent, and they tend to shift. People tend to talk about them in different ways. And so it's not a constant static thing at all. Case in point, you only need to do some cursory searches of the COVID-19 pandemic, and you see a ton of conflicting policy messages. So these are just all news articles, and you can see our friend Boris Johnson, has this confusion about getting out, staying at home, testing, not testing. Another one on Anthony Fauci defending these accusations. I believe this is when he was testifying as to flip-flopping on things like mask mandates. And it's not just in the US and Britain. Lots of developing countries are going through a similar thing as well. So our theory, and we'll kind of work back and end with this once more, is that government policy dissonance tends to lead to policy uncertainty, and that's going to raise financial market volatility. So unexpected fluctuations in asset prices. So let's start kind of from the basics and build up to this. In social psychology, there's a notion of cognitive dissonance. So this is a really old body of literature. And the idea behind this is that when faced with dissonant attitudes, actions, or information, an individual who's now out of step, with what they believed before, will seek to reduce this dissonance kind of as quickly as possible. And the way that they do this tends to vary a lot. And sometimes they tend to fix this dissonant in really unexpected and surprising ways. So this is a established body of literature in social psychology. There's, we're both political scientists, so there's a little bit less examples of this in the literature. We were able to find a few nice examples. So there's a 2018 article that looks at why citizens tend to shift their political attitudes when those attitudes come into conflict with their political actions. There's another article that looks at why Supreme Court justices will actually sometimes file separate opinions to basically drive out the rationale behind their opinion that conflicts with prior opinions. So again, it's kind of this unexpected reasoning to explain your new decision. And for our purposes, we're going to use this in that national leaders, when faced with these dissonant cognitions, our expectation is that they're going to take steps to bring these cognitions back in line. And where this is going to matter for markets is that they may at times do this in an unpredictable way or inconsistent way, and that's going to cause policy uncertainty, and then that in turn is going to affect markets. So going back to our previous slide here, we've kind of solved that first arrow of dissonance will cause this sort of policy uncertainty. Second argument is, does policy uncertainty affect financial market volatility? There is a very large literature in political economy on this. So I'll just give you a few quick examples. This would be, if it's not clear who's going to win the election, markets really don't know how to react. So there's some clever analyses of the 2000 US presidential election, where for a little bit of time, it wasn't really known who the president was going to be. And kind of markets went a little crazy. In terms of cabinet formations in parliamentary systems, it's unclear who all might make it into that cabinet. Again, this uncertainty raises volatility. If you have things like, cabinet collapses and stuff like that, that matters as well. So this part is kind of less of a stretch here. This is pretty well proven. So our form of policy uncertainty is different than we've seen in the literature before, but in general, right, this uncertainty is expected to raise financial market volatility. So just completing our theoretical argument, we say that government policy will get out of step every now and then, and there'll be this dissonance. The politicians will attempt to adjust their policy cognitions. Sometimes they're going to do this in unexpected or unanticipated ways. This is going to increase policy uncertainty. And then investors are going to adjust their holdings accordingly. And this process of, some investors going high, some going low, that's going to raise financial market volatility. So unexpected swings in the market. Our empirical focus is looking at Donald Trump's 2020 COVID-19 policy statements and how that affects US financial markets. We've done a little bit of stuff looking at other financial markets. We probably need to pick that back up. So our expectations are twofold, and I'll get into exactly what the difference between these two measures are. So our first expectation is that increased policy dissonance among Trump's day-to-day pandemic-related policy statements. So this is like on today's Monday, on a Monday, if on Tuesday his statements are just completely different, that will raise financial market volatility. The other one is that Trump's within-day pandemic-related policy statements will raise financial market volatility. So this is like saying on a particular day, if he's all over the place in terms of policy related statements, that will affect financial market volatility. So our dependent variable is the percentage change in the closing price of the S&P Composite 1500 index. So there it is on the left. Obviously, you can see as COVID hit, right, the stock market tanked, and then it pretty much has been on a continuous rise ever since. So that's the raw series. In order to render this series stationary, we take the percentage change. And you can see on the right that there's a lot of fluctuations. It appears that, in the spring, right, the S&P was kind of all over the place, both in the positive and negative direction. Things kind of settle out, mostly in the summertime, but then they kind of ramp back up in the fall. So this is what we're going to be modeling on the right there. Let me tell you a bit about the S&P 1500. It's comprised of a little over 1,500 US-based companies. It comprises 90% of the US equity market. So, this is the financial, at least in terms of equities, market in the US. It includes large, medium, and small cap companies that we'll get into in a little bit. And what's nice about this is it includes all economic sectors. So something like manufacturing, service sectors, and tech would all be included. And it includes both old companies as well as new ones. And our analysis is from the 2nd of January of 2020 to the 3rd of November of 2020. So that's the day before the presidential election, for about 211 market days in our sample. So that's our dependent variable. Our independent variable is this measure of COVID-19 policy dissonance. And to create this, we scraped all of the speeches, remarks, and briefings that are available on whitehouse.gov. So this is like everything that's said or put out by the White House in the course of a day, and it's compiled over every single day. And in 2020, there were about 1,500 speeches. This we split into a little over 83,000 paragraphs. So we're going paragraph by paragraph. And of this, we wanted to tag paragraphs that were spoken by Trump. So sometimes that's really easy where, at the title, it'll say remarks given by the president. Other times it's a little bit less clear. And what we wanted to do was separate it out from other people. So Mike Pence was giving statements about COVID. The First Lady gives statements. And so we got rid of all of those and just kept Trump's paragraphs. So there are about 55,000 of those. From these, we wanted to identify the COVID relevant paragraphs. So we created a dictionary of about 200 words. This came from the Government of Canada, published a glossary of the COVID-19 pandemic, which is pretty exhaustive. And then we supplemented that with the Oxford English Dictionary. Every month, grab the top 20 trending COVID-related search terms on Google. So month by month, as things kind of shifted in terms of what we were talking about, you could think of things like vaccine and lockdown kind of came later. We would be able to pick up all that stuff as well. And so, so we tagged about a little under 14,000 of Trump's paragraphs are directly related to COVID. So, one or more of those terms were picked up in a particular paragraph. And then from here, we created a paragraph by paragraph sentiment score. So this is whether the paragraph on the whole is positive in tone or negative. We're going to include valence shifters. So something like not good doesn't get construed as good, right? It's bad. And we're going to use just a common sentiment package for this. So this is where it's a rough measure of dissonance, right? Because we're going to be looking at swings from positive tone to negative tone. Ideally, we would want to get measures of changes in policy itself. as you might imagine, that's quite difficult. So this is, our rough cut at it as of now. So this is just what to give you a better sense of what this measure looks like. On the top right, you can see I think that's 15 most COVID-related terms that occur. So Trump talks a lot about the virus. He talks a lot about health and testing. And of course, there's tons of words in the dictionary that he doesn't use once. But there's quite a few that are really common. On the bottom left, you can see our measure. So this is Trump's COVID-related sentiment in 2020. As the sentiment increases, it means that Trump's statements are more positive. As it decreases, it means that his statements are getting more negative. What's clear is it's all over the place, right? So there's times and days where it clearly appears to be negative, and other times where it appears to be positive as well. And it doesn't seem like there's a particular pattern, right? Like he's not consistently getting more negative or more positive. So that's the underlying measure. Based off our two hypotheses, what we're going to do is turn those into our policy dissonance measures. And the one on the left is the day-to-day absolute change in COVID sentiment. So we're going to kind of subtract whatever was going on the previous day. And then we're going to take the absolute value because our intuition here is that any changes, if he's becoming more positive or more negative, are likely to affect markets. So that's why we're taking the absolute value. The one on the right is the daily variance. So we took the daily variance for all COVID-related paragraphs on a given day, and we subtract from that whatever the variance was on the previous day. And so you can see like early on in 2020, the change in the variance is pretty large. It kind of settles down in late the spring, and then it does appear to pick back up throughout the rest of the year. And that was hypothesis 2. Our model that we're going to use is something called a generalized auto-regressive conditional heteroscedasticity model, or if you don't want to say all those words, you can say Garch. If you haven't taken a time series class, you may not know what this is. The down and dirty is normally I'm modeling the conditional mean, right? I'm modeling the expected value of y given a set of covariates. And that's exactly what we have up here with some slight differences. So the percentage change in our S&P measure is going to be a function of its lag, our dissonance measure, and then a few control variables that I'll talk about in a minute. What's different about this is that normally sigma squared, our variance around, you can think of it as either the error or the dependent variable itself, is normally just a single parameter that we estimate. And so Garch models allow the error variance to change across time. And what that does is really the sigma squared sub t that you see there in this conditional variance equation is often best thought of as volatility, right? So after doing as good of a job as we possibly could to predict the value of the S&P 500 or 1500, there's this additional amount of variance that's left over and unexplained. What's interesting about it is that variance, and because we're on Zoom, I can do this, right? That variance is a function of previous unexplained fluctuations. That's this omega epsilon squared, and also the previous level of the conditional variance itself. So what we'll see is there's like persistence in volatility across time. So really that bottom equation is what we're going to focus on. What we can do is we can actually add regressors to that conditional variance equation. And so what it allows us to do is say, well, does increases in dissonance actually drive volatility? The last thing here is we include a few controls. We want to include a control of the actual violent events itself. So we're going to include COVID cases and deaths. We're going to include the probability of Trump winning re-election. So I think it's the Iowa prediction markets has a continuous measure of the probability that Trump is going to win re-election. And we're also going to use the 10-year Treasury bonds as a measure of like, what are other market interventions that might be taking place. So we'll kind of walk through this, and then I'll give you an easier takeaway here. The first step is to say, do we actually need to run the crazy model that you saw on the previous slide? So we're going to run on the left here, these two models, just two plain old OLS models. And there's actually a test for whether you have that sort of volatility in your error variance. And what you see down on the bottom here is, yes, we find evidence of that. So that's kind of step one, is we pass the test. We should be estimating these Garch equations. Our next step is to kind of interpret the Garch models themselves. So you can see there's a bunch of parameters here. Up top is the mean equation, which you can actually see like none of our COVID dissonance measures appear to be significant. That's because that's not really what we're trying to model. So we don't think changes in dissonance should be affecting the level of the S&P 1500, right? It's going to be affecting volatility in the S&P 1500. And that's what you're getting at down in the blue box is what we want to look at. So you can see that the two COVID measures, this one is the day-to-day change is positive and significant, meaning all these variables are standardized, meaning right as dissonance is increasing, volatility in this stock market indicator is increasing. We see the exact same thing too when we look at the variance. So it kind of roughly, right, it appears that our hypotheses are confirmed. We see a bunch of other stuff too with the controls. So it looks like the changes in the Treasury bonds tend to decrease volatility. And then as Trump becomes more likely to win, volatility also was decreasing as well. We kind of get mixed evidence as to whether COVID cases and deaths are increasing or decreasing volatility. So happy to talk more about the actual other stuff that we find. We kind of went quickly through that because it turns out those models are pretty hard to interpret. And why is that? Well, you can see that everything in our model, so the vector of controls as well as our dissonance measure, appear to affect sigma squared through an exponential link. So why do we do that? Because we know that variance has to always be positive. But for us, it makes interpretation difficult, right? Because if I want to say, what's the expected value of volatility, I need to tell you what every single other covariate is set to. So, the most similar thing that you're probably used to dealing with this is with like a logit model, right? Where if you want to calculate something like the probability of y being equal to 1, you actually have to, figure out what you want to set all of your x variables equal to. So our way around this that Allison and I, this is our Trump paper here on the left, that Allison and I came up with was to actually simulate the expected conditional error variance, just to get a better sense of like, what does volatility look like? And then how does it move over time? We're also working on a kind of more advanced version of this with another co-author. So I'll just kind of briefly talk about what we're doing, and then I'll show you some graphs. So we're going to estimate our model. You saw that on the past few slides. We're going to draw a bunch of simulated estimates. And I think in the interest of time, I'm going to kind of quickly go through that. But basically, we're going to simulate our parameter estimates and get like 1,000 of those. We're going to set all of our regressors to their mean value. And then we're going to go through and predict the conditional error variance. And then we're going to kind of keep doing that over time. And then all of a sudden, at a given point in time, we're going to increase the dissonance measure and then see how it affects the error variance. And then we're going to kind of plot that over time along with 95% confidence intervals. So really, this is the two models that we kind of briefly talked about in the table form. this is how they look like as a plot. So what's nice about this is we've scaled the y-axis in terms of expected volatility as a percent of the pre-shock volatility. So instead of a meaningless number, right, we can see that here, given a shock in COVID dissonance on day 3, after about 3 days later, the volatility is about 50% more than it was in the pre-shock period. After about 12 days, it kind of settles at maybe 60 or 70%. So it's a pretty meaningful change, right? Looking on the right, that's the change in the variance measure or hypothesis 2. We see a really similar thing. So I think the magnitude might be a little bit bigger, but basically the same thing. So it's not instantaneous, but after about like 2 or 3 days, the markets appear to kind of either price in or experience this increased volatility. So that's the main finding. We have a bunch of robustness / alternative arguments that you may or may not find convincing. The first one is, and I briefly mentioned this, the S&P 1500 is made up of those 3 different caps. And large caps are what you a lot of times normally think of. And those are like big investment portfolio grade firms. They're actively managed, but they tend to be low risk, right? So these are like your retirement target date, like safe assets. Small caps are also like really actively traded, although they tend to be high risk, right? So, if you're being really aggressive, you'd want to probably trade in these small cap firms. Mid caps are a little weird because they're kind of somewhere in between. And there's a lot of evidence that like no one pays attention to them. No one invests money in them. And it's not really clear what you should do with them. So our expectation here is basically like if people are paying attention to the small and large caps the most, that's exactly where we should see the most volatility. What do we find? It's kind of mixed, right? Although it's in the general direction of what we saw before. So when we split it out by the different caps, you can see that all the way on the left, those 2 columns, those 2 rows on the left are the large cap. It appears to be the most affected by increased dissonance. Mid cap actually appears to be like the next most affected. And then the small cap is almost the least affected. So I don't know if we have a good reason as to why the mid and the small are kind of against expectations. But we do see that the large cap does respond the most to greater amounts of policy dissonance. Alternative argument number 2, you might say, well, I think you have your causal arrow flipped. I think that markets are doing the driving, and then Trump is, talking about COVID or talking about COVID in weird ways, just to kind of respond to the market. And so what we end up doing is estimating, you get not 1, but 2 weird time series models today, a model called the vector auto-regressive model. So it really relaxes a lot of our exogeneity assumptions we make in single equation models. And we conduct something called a Grainger causality test, which is one time series way of kind of looking at cause and effect. Really what we find is that that doesn't appear to be the case. So it doesn't really seem as though the markets are driving Trump's policy related statements. So that's kind of in favor of our argument then. And I'm happy to talk about this stuff more in the Q&A. Alternative argument number 3. As I mentioned briefly, like Trump was not the only person talking about the pandemic. There were lots of other US policy officials that had pretty active and prominent roles. So maybe Trump is kind of just like the symptom that we're seeing of this like internal disagreement, and it's not really him that's doing the driving. So, pretty much out of convenience of we have the data for them. Vice President Mike Pence was assigned to that COVID pandemic task force. And then Kayleigh McEnany, the White House press secretary at the time, she regularly gives press briefings. And so these are 2 great people to look at. to see whether their dissonance also drives markets. One way of testing this is to look at those causality tests, and we don't really find any consistent evidence that one of these three actors, right, Pence, McEnany, and Trump, are driving one another, and that's their measures. In terms of the dissonance stuff, we don't really find anything. I would urge caution at looking at the bottom left one because those estimates are not super stable. So, right, we might say, if anything, it looks like Pence and McEnany's day-to-day dissonance might actually decrease volatility. It's certainly not increasing volatility. They're not really doing anything. Alternative argument number 4 is that there could be these time varying effects. So maybe investors are paying super strong attention to what Trump is saying and how dissonant he is. When COVID was first coming out, right? You could think back to like how uncertain and not knowledgeable everything was. And then maybe investors wised up as to like, well, White House statements don't really seem to matter. So what we did here was we just create the Garch models ask a lot of your data. So this is kind of one of the easiest ways to do this is we created these 4 seasonal dummies and interacted them with our dissonance measure. And what we find is kind of this argument at the top appears to be true for day-to-day dissonance. So, unexpected changes in tone from yesterday do appear to decline, at least in terms of affecting volatility over the course of a year. But if anything, the within day dissonance, so that was changes in the variance, tend to increase over the year. So it's not exactly clear. It doesn't appear that this time varying, wising up effect is really taking place. The last, and I promise final alternative argument is the following. So we've just been looking at the unexpected fluctuations in the composite indices. But it's likely too that so this is meaning that some investors are kind of thinking that the market's going to improve. Other ones might be kind of countering that. And so what you end up seeing is this unexpected fluctuation it manifests itself as volatility. If all those people are all of a sudden trading, it's also likely that volume of trading should go way up. And so what we do is we estimate, hey, you get a third time series model, just plain old time series models looking at trading volume across the different S&P indicators, right? So like, does the number of times this indicator was traded increase in response to greater dissonance? And similarly, we kind of get these mixed results. So that within day variance change measure does appear to increase trading volume. And we don't really find an effect for this day-to-day dissonance. We don't have a super strong justification for these findings. Maybe investors respond more to this shifts in day-to-day overall, like the spread of dissonance, rather than to what are really like absolute shifts in the average level of dissonance. But again, it appears that possibly it's taking place, kind of mixed evidence there. So just to summarize here, and then I'll open it up for questions. Where are we contributing? There is this pretty big literature on elections, institutions, this sort of like political uncertainty and how that affects markets. So in a way, right, by looking at elite speech, we're contributing to this, how does politics affect financial markets? So that's kind of one of our main contributions. I think the other contribution here is that we're looking at a new type of policy uncertainty, which we've termed policy dissonance. And so it's really major event takes place, government responds to it, government responds in dissonant ways, and then that leads to this uncertainty that affects financial markets. And that's kind of our new claim here. And so what we find is, of course, that elite policy related dissonance in terms of Trump's statements tend to increase market volatility. And we have a little bit of a methods contribution here. So, there's not a ton of, but definitely is a growing field of people turning these text as data projects into a time series measure and actually doing these time series analysis on them. And then the dynamic simulation stuff, which again, we're the second people to do that after our previous paper. So yes, thank you all for listening, and I look forward to your questions. I see David Burst's hand.
I think I'm unmuted here. Can you hear me?
I can.
Okay. I saw you present this, I think, a year ago in the department, and so I may be repeating myself, but I realized the comment I made didn't show up as at the end here. So I guess perhaps the way to phrase this is, I guess I have kind of either a meta reaction, or maybe this is the form of a question. And your focus here is on policy dissonance. And so you're going to do what somebody might call a quantitative case study on the Trump administration. But what I worry about here, Andy, is that packed into this case study is an alternative story. And I'd like for you to convince me that this isn't true or that it's controlled for. And that is that it's not just policy dissonance that could drive market volatility. And in fact, I'm not even sure there's big questions about that. Of course it could. But other things can drive it too, which is the policy itself. And so what I'm imagining here is that some of what we're observing could be in policy dissonance, policy itself, and more specifically, bad policy. And bad policy might drive down markets, which will show up as volatility. But so to what extent do you have, I'm trying to think how to phrase this, good controls for what policy is, so that we're confident that this change in sentiment is not picking up on actual policy? For example, one of the things I thought of here was, and I'm not suggesting that you need to go do this, but I'm imagining, if we imagine that, let's say, the Trump administration had in general bad COVID policy, and let's pretend for a moment that the Biden administration generally has had a better COVID policy. What might be really convincing to somebody like me is if I saw the same patterns in the Biden administration. That is, whenever there's this change in sentiment, we get these change in markets. But it's not necessarily downward trends. It's, is this making any sense of how to unpack policy itself? Bad policy should produce downward movement in markets, which will get picked up in the volatility. How do we clean out policy itself from policy dissonance?
Yeah, I mean, I think you're onto a good thing. And I think to some extent, like, that's the one thing that's difficult to do with the kind of, the fairly coarse measure that we have is like, a lot of times he's probably talking about certain policies. I think the COVID cases and stuff are probably a rough measure with a pretty big lag of like whether certain policies are working or not. I really like your idea of looking at Biden, because I think that's, I think it wouldn't be a hard stretch to make of like lots of people would argue that the Trump administration bungled a lot of the pandemic response. And, Biden had either, you could argue, a better response or the luxury of a year later. So I really like that idea of, if we showed that Biden also, when there are dissonant statements, is affecting markets just as much as Trump, I think that would be a nice way around it. But but yeah, it's hard with the policy stuff as to how we could like proxy for that. Because I do know that nowadays there are a lot of these like policy strictness measures, but those are usually at the state level. So yeah, but yeah, they're good points. I don't know if I have a super strong answer, but I like your idea. So
thank you. I think it was Clara and then Alex, if I'm not mistaken.
But I can go. Yeah, I'll go. Mine's related to David. So yeah, I like David. I'm thinking, what's hypothetical, right? It could be that Trump, if we think of a hypothetical that Trump was silent or was not there, or we didn't hear him say because Twitter banned him already, then investors could have still responded to the market changes in COVID cases and the lockdown policies around the world that affect supply chain. So even if you don't have Trump, do we see this, right? And one way to do it is, I think, maybe including news variance. So like you have this great measure of Trump's dissonance variance, and maybe you could do some more text work in terms of coding the news and how dissonant news was, and whether the investors are responding to the news with or without Trump statements, right? So that's, I think that's something that you could do. And then I know you had a robustness check about Trump not responding to the financial market. I'm still not convinced, but I think that concern could have been maybe accounted for if you include the news, like how investors could have disregarded Trump and then just do whatever they do. And then the second one is why S&P? Why not Dow? I think in some sense, I think S&P is a harder case for you because it just kept going up, and because it's focused on tech. But I wonder if you had done for Dow as well, which covers more variety of stocks and industries. And then the third small point is you had like some tables about expected volatility after 3 days or after 10 days or after 12 days. And I think after 3 days, it moves on to the new news, not to the, what he said or she said 3 days or 10 days ago. So those are kind of 3 points that I had.
Yeah, so I think those are good points. I'll respond just real fast. I like the measure of the, like the news dissonance or news variance, or even like positive, negative news tone. I know, like Chris Valasian and co-authors have some stuff on general like macroeconomic tone. So it would be even better if someone with lots of time on their hands made a measure like that. So I think we'll definitely do some searching. S&P versus Dow, I don't know if we have a good justification. I think it's just that I'm sure Allison would have many more words to say than I, but I think just because it's like a big common market indicator. I will, tell you that in our experience from reading a lot of the financial economics literature, people will show you like one indicator. And I think like that's not a great thing either. So we at least have the parsing it out to the small, big, and large caps. And then in terms of the time series plots with the expected volatility, we've gotten, like a lot of the methods work I've done in time series has kind of used these sorts of plots. And we've gotten this comment a lot. And I think the answer that I would have to it would be like, this is almost like an all else equal plot, right? Of like, we know that of course, like in the next day, other stuff is going on, but you wouldn't be able to see our total effect of the impulse that we're showing you, net of all that other stuff. So yeah, I mean, it's valid that like by, the next day or two, like Trump might have said something different and then things have gone down or up. So yeah, this is like the closest thing that we can come up with to like an all else equal. But yeah, good questions and comments.
Thank you. Alex and then Karu.
Great. So first of all, thanks, Andy. It's really nice to see how far this has come since the earlier version you presented in the department. And I think it's a really interesting project. For me, the main question is just what is the dissonance actually measuring? And is it measuring what you kind of think it's measuring? And specifically when you think about doing sentiment analysis on these paragraphs, one thing that's really challenging is it's hard to know what the object of the positive or negative language might be, right? So it could be the case that there's one paragraph that's like saying something negative about China related to COVID, and then another one that's saying something, you know, that's against Democrats' mask mandates or, you know, lockdowns or something in the next. And so, you know, is it actually policy dissonance if the target of the positive or negative sentiment might be about really different issue areas or topics? So even if you don't want to kind of go down the more laborious path of training like a supervised machine learning kind of model to help measure this in like a little bit more or kind of less of a blunt way than the sentiment analysis, maybe dividing it up so you could better understand if you're seeing these fluctuations in sentiment on like really similar subtopics within COVID, might just help us to get a better sense of what you're measuring and kind of what this dissonance is actually capturing. And then within that, even if you stick with what you have, just seeing validation of what it appears to be picking up. Like if you look at the days with the biggest swings, what's actually going on in the text there. So thanks, and really looking forward to seeing this in print.
Thanks. Yeah, well, I always get scared when Alex asks questions because she does a lot more text as data than I do. I mean, I'm sure the wise ass text as data answer is this would probably like bias things, you know, against our expected direction. I like your idea of doing, we have gone through and kind of looked at the paragraphs, and I think even looking at like the word, you know, the terms that are popping up was helpful for us. But I like your idea of kind of picking out either like a random set or kind of the biggest movers in our indicator and see like, does this actually make any sort of sense, you know, if like what he's talking about is at all related. I do know, and I know we had talked about this before too, of like, we have a long-term goal. I don't know if it's on this paper or something else, of even looking at like his tweets, just to get a like, you know, minute by minute analysis of here's a specific policy that we can analyze and actually understand, and we know he's talking about, and then we see that markets respond in a similar way to what we see when we use like the big indicator. But I like your idea of looking at like certain words, you know, such as virus or like, especially like lockdown, right? Because that's going to be US specific rather than like virus or, you know, because he was always saying like China virus and stuff like that. That could be a little bit more global in terms of context. So I think that would be a easy, quick thing that we could do. So I like that.
Thanks, Karu.
Yeah, I'll jump in. Andy, thanks so much. This is super interesting. My question is about sort of the conditions under which you expect to find this relationship. So I'm just curious, you know, I mean, Trump is obviously so interesting, but also there was so much else going on. And so I'm wondering, I guess, specifically about whether like trust or confidence in the administration or in government would change how you expect. I mean, it might be that we just see less policy dissonance, but so I mean, like, would you expect the same thing under Biden if you or other administrations if you could, or is it something particularly about like kind of the extent to which Trump would sort of go back and forth on things? Does that make sense? Like sort of the overall context, like, do you expect this everywhere, or is it sort of unique to the conditions of the Trump administration?
Yeah, I guess like my response, and this is kind of similar to David's idea too, where I think it'd be like an especially good test of what we're trying to say is like, and we did a bit of this in the AJPS paper too, is like, Trump is unique in a lot of ways, obviously, but you know, to some extent, it's that he's like a unknown policy actor, and so a lot of his stuff, markets don't get a sense of like what he or his administration's going to do until they either talk about it or actually do something. So I like the idea of like, yeah, if we looked at Biden, you know, when there were changes, which I mean, I'm sure there have been, in terms of like dissonance, like, if we found that also is affecting markets, that's a nice kind of justification of like, it's really the dissonance, not like believability. I think the other point that you raised at the beginning too was, maybe proxying for, we did add like the probability of winning, because that was, someone had mentioned a while back, like he could be kind of doing a flurry of just general things as it becomes more or less likely that he's going to win re-election. And so markets are responding to that. I like the idea though of like trust in the administration, which I feel like had to have been asked by someone over time. So that might be another like nice way of seeing, as trust was kind of fluctuating up or down, how does, how are markets responding, and is it changing at all? So that's a good idea.
Any other questions? All right, we have a couple of minutes left, so I did have one quick question, Andrew. Maybe it's been already addressed in some ways with your answer to especially Clara's, but statistically what prevents you from adding, for example, the average number of cases in the prior 7 days, or some measure of the intensity of the pandemic, for example, to see whether that's affecting volatility? And because I imagine that actually, Trump's dissonance may not be only related to his prior comments in the prior days, but relative to what's going on out there and also what other people are saying, right? So I don't know if that would be an interesting form of or a way to explore dissonance as well.
Yeah. So like in terms of the COVID cases and deaths, so we control for those. As some of you might know from taking like a time series class, this like exponential growth term is a little hard to model. So the way that it's in our models are these, it's almost like acceleration in cases and accelerations in death are what exactly is in the model. But I like your idea, and like you were saying, kind of what Clara was saying too, of like these other proxies that we might include. And I think the newspaper is a good idea. I think the other one might be some sort of like state level measure of either lockdown or maybe something like the spread of cases in terms of like, there were times when like some states were kind of on the way up, and then other states were kind of increasing in terms of their cases. Something like that of almost like attention to COVID. And I think like a state level measure, just because I know those have been created already, some sort of summary measure of that might be another good way of seeing like, are people paying attention to COVID actively, and is stuff on, like during we talked like last year of like this first wave, the second wave, right? Like I think when the news started talking about like the waves was when people were especially paying attention to this sort of stuff. So I think that's a good idea of like somehow proxying for that.
Thank you. Okay, so if there's no more questions or comments, I think we'll let folks. Thank you very much again, Andrew, for your.
I'm on the call, but on phone. Can you hear me?
Yeah, we can hear you.
Oh, sweet. Because I couldn't get onto the Zoom. Maybe this is off topic, but I just wondered, I've just been considering trading options lately, and I wonder how time fits in to all of this, since obviously COVID changes like instant by instant as to long-term volatility in the markets. And I was just getting excited about starting to trade options. I'm not skilled at all in this field. I'm in healthcare, actually, in medical imaging, but I just wondered if I might throw that out there.
Yeah, so I do think, right, like the volatility is a relatively short-lived thing, kind of like what Clara was saying, although it does have this sort of dynamic persistence across time. So like if there's you can think of like a terrorist attack, like something like volatility is going to increase in the day of the attack, but then it's gonna, the next day it's still gonna be there, but probably to a lesser extent. I think, and we did some of this with our previous paper, was kind of talking about like who is doing the volatility. And I think that's where, your comment about options trading, which like over the past year, the amount of like new investors has increased like crazy, are these like noise traders who are really, they're not like big asset managers. They're kind of just trading on news and information. And so, for every person that all of a sudden says, oh, asset prices are going to increase, there's another person that says, oh, I think they're going to decrease. And so it's really like these people are kind of canceling things out. But overall, the effect that we see, like in the models, is increased volatility, right? The fundamentals that we include in the model during these volatile periods just do a bad job predicting. And so really that's, that it's strange, right? The paradox of these sorts of papers is like the thing that we say matters is exactly the sort of stuff that we can't model. And that's really like what this volatility is.
Well, thanks again, Andrew. Thank you all for coming again and sticking around.
Yeah, thanks everyone.